Welcome to Terry's Tips for Stock Option Success. Today we are going to give you a brief overview of our 3 proven strategies to help you decide which one is the best one for you and your personal investing style. Since 2001, we have been fine-tuning our strategies for the current, always evolving market conditions, and these are the ones that Terry has found the most valuable: the 10K strategy, the credit spread strategy, and the diagonal condor earning strategy. The 10K strategy is made up of calendar spreads, diagonal spreads, and vertical spreads. The vertical spreads are primarily used for adjustments with this strategy. Being able to make adjustments on the fly is where the true magic happens and where most options investors give up. It can turn a losing proposition back into a winning play or allow you to survive to trade another day. Without the skills necessary to make adjustments, you will have a very short and likely unpleasant options experience. The portfolios that trade the 10K strategy include the Wiley Wolf and the Rising Tide. In 2017, the Wiley Wolf made over 700% profit. It started at $3,000 and ended out the year by taking out $19,840 of profit and restarting with $5K, so new subscribers could participate with a lower buy-in rate. The Rising Tide ended the year with only a 150% gain. With results like these, you can see why the 10K strategy has been the cornerstone of our options services. The credit spread strategy is made up of selling a bull put credit spread, which is the most commonly used term. It also goes by the name of vertical spread, credit spread, call spread, or bear call spread. You would use different variations depending upon what you think the underlying stock is going to do over time. As we've been in a bull market for the last 5+ years, most of our traders for this strategy are bullish in nature. The credit spread strategy worked great for all our portfolios in 2017. In our current market, this strategy has proved the easiest and least prone to drawdowns. Currently, all of these portfolios are in positive territory. If you're new to trading or like something simple and straightforward, these portfolios are the best ones to follow. Our newest strategy is the diagonal condor earning strategy. This strategy starts out by placing a diagonal put spread and a diagonal call spread, ideally both for a small credit. Once the earnings announcement is made, the trade can be closed out if it stays in the predetermined range. If it moves outside of that range, we transition the strategy over to our 10K strategy and have another 5 weeks to make up any initial loss that would occur with too big a post-announcement move. You can read more about this strategy on our blog at terrystips.com. Vista Valley and Honey Badger. Both these portfolios did well in 2017, but were not used with the diagonal condor earning strategy. Terry was still testing this strategy in his personal accounts and decided to add it to the mix in 2018. These two portfolios have smaller unit values so that those wanting to get involved but not risk too much of their cash can still participate. Which strategy should you use? A very good question. The 10K strategy is the most active as it trades in weekly options. It also has the highest potential for both making extraordinary gains but could also have large losses. Losses are mitigated by adjustments, though there can be large swings in account value. That is something that you should think about and be prepared for with the 10K strategy. The credit spread strategy has been one of our most popular since we started adding this in a few years ago. In the options world, it would fall under the moderate risk, high reward category. It has consistently produced positive results, and the fluctuations in portfolio value are smaller than in the 10K strategy. In 2017, all the credit spread portfolios made gains between 40 and 79%. This strategy is also good to use on your own for other underlyings that you might find your liking and is a good place for both new and advanced traders. The diagonal condor strategy falls under the moderate risk, high reward category as well. Self-directed traders would receive the trade alerts from us and place the trades on their own. If you're doing trades on your own, the credit spread strategy is the best place to start in terms of time and ease of trading. After that, the diagonal condor earning strategy would be considered moderate, and the 10K strategy for the most active traders. Lastly, if you want to take advantage of options but don't have the time or inclination to do it on your own, then the auto trade program at Thinkorswim is the way to go. We send the trades into the auto trade desk and they will place them in your account for you. You never have to miss a trade again. And while all of our trades are fine to do in an IRA, you must have a regular margin level investment account to participate in auto trade. If you don't already have a Thinkorswim account, contact me and I will tell you how to get a free 4 months of our premium service. That sums up our 3 Terry's Tips stock option strategies. If you have any questions, don't hesitate to reach out to Seth@terrystips.com. Happy trading.